Today's our guest is Charles Carrillo from Harborside Partners. Welcome, Charles.
Thank you so much for having me on today.
Awesome. Thank you very much. Likewise. And a little bit about Charles. Charles is the managing partner of Harborside Partners, a real estate syndication firm, and has been actively investing in multifamily and commercial real estate since 2006. Since that time, he has invested in over 200 million worth of investment real estate. Charles is also the host of the Global Investors podcast, where he interviews professionals about investing in US real estate. So, with that, Charles, you want to add anything to your background?
No. It was very good. It was good. You hit all the main points. But so yes, I've been an investor since 2006 in my own properties. I grew up in a real estate investment family. My dad was a multifamily investor since 1984, starting with a 6 unit. And him and a partner, they bought, I think, no syndication. They bought it with their own money up to about 100 and I think it was about 100 units. But back then in like the 80s and 90s, it was much different in the 80s buying properties with getting financing and people signing properties over. So it's not like today where it's 20%, 25% down, and you have to you go from there. But so I learned about it, but the most of the properties my dad was investing into were D-class properties, C- properties, let's say, to be nice. And it was terrible. I mean, you made money with them, and his cost was like so low on the properties that you couldn't really lose. But just an asset class that I always wanted to avoid. And then when I got out of college and when I was going to go buy my first property, he really stressed to buy better properties in better areas. And I think I started off with like a C-class property, and it was a 3-family. And back then it was, they call it house hacking, but back then it was just, living in one of them and renting out the other 2 to kind of take care of the majority of your mortgage, which we did. And then I bought another property about a block and a half away a couple of years later. So I built a small portfolio, and I bought a mixed use commercial / multifamily apartment building a couple blocks away from that. So I started building these properties, this little portfolio between 06 and 2012, and I self-managed them during that time. And that was a lot of work, but I got it really honed in toward the end of it. And then I moved to Florida in 2012, and I've had professional managers manage that for 10 years. And I sold that whole portfolio in 2022 to a New York investor. So that was kind of my forte into real estate investing and self-managing and really learning about dealing with tenants from the ground up. And then since being in Florida here over the last several years, we've really focused on larger properties and involved with syndications.
Thank you very much for sharing that. And also, you touched a very, very good point. Investing in better locations or better properties and stuff like, D class or, C class. The challenges with that is like, managing tenants or, rent collections or delinquency is biggest challenge, right? So that is the main reason. Yeah. Got it. And let's jump towards personal side. You travel 40 countries, travel 47 US states. So share me some, experiences or some lessons learned from that.
Yeah, so I was previously, before going full-time into real estate investing, I was running a small online business, and I worked with partners, and I had clients that were in Europe. So I would spend 2 to 3 months a year in Europe throughout the year. And so I did a lot of traveling. That's where I get that at this point, 40 countries that I've been to. And I used to meet with people that would be, they're business owners, and they'd like to, you're talking about what you invest into. Everybody wants to know what other things you're investing into. And so I was telling about US real estate, and they're like, well, how can I do that? I'm not a US person. Is it possible? And I really had no idea. So that was kind of like the whole point of starting my Global Investors podcast, because most people don't understand. And I didn't know starting out when I started the podcast how to do it. It was really just interviewing people. And after so many episodes, I kind of realized how it was. And then we have, my first passive investors years back were international European investors. And so not living in the United States, and they invest in the properties, and I was able to put them together with the professionals to be able to do that. And now it's a lot more of a honed process of kind of how we speak to them and how we can give them the names and contacts, and they can choose the professionals they want to work with to get set up here correctly in the United States to make sure that they're not going to have some huge tax consequence down the road. And there's so many nuances when you're investing to another country. I mean, what we take for granted, here is, opening up a bank account. It can be very difficult for someone that's not a U.S. resident, U.S. citizen. Businesses, opening up businesses are very different in different countries. I mean, they vary from country to country. And some are easier. Like I would say the United States is pretty easy. Some are very difficult, some of the European countries, for instance. So people come here and they don't know how easy it is, and they don't know the process for it. So putting them together with the professionals, CPAs, accountants, and also attorneys, that possibly are from their country of origin, or work with a lot of investors from their country of origin, and that assists them in doing it. So the traveling has really assisted me in kind of branching out my real estate investing to offering it to more people throughout the world.
Got it. So yeah, definitely great points there. So investing from as a foreign investor's point of view, touch on his tax point of view. There are a few other stuff also there, right? Identifying right sponsor and also, right markets, right deals. So share me some best practices from foreign investors' point of view.
The main thing is coming in and aligning yourself before you start investing or looking at deals. The main thing is really to get aligned with a professional that's going to understand the nuances of the tax treaties, mainly between your country origin, where your tax residence is, and where you're like investing in the United States. So that's number one, is getting that set up, and then also having some sort of idea of, hey, I'm going to make a one-time $50,000 investment. So tell your person that it's going to be a different setup than, hey, I'm going to invest $1 million over the next 24 months. They're going to have usually it's going to be a slightly different setup for you, because there's going to be higher tax consequences if it's not done properly. And then also, if you pass away, where your taxes, yet your heirs are going to be susceptible to. So it's, number one is getting aligned up with the right professionals. Once you have that, and that takes, from beginning to end, if you have no setup here or no base here in the United States, it can take a couple months, right? From getting ITIN numbers, between getting your LLC and your EIN number and bank accounts. So do the process and start the process earlier than later. The next thing is, if you're passively investing, which many people are, because it's much easier than doing it actively and trying to manage property. I mean, I manage property, even managing property that you're in the same town of can be difficult, let alone a different country. And it all comes down to the team. I understand that, but for new investors, they're not going to have that team. So that's going to be one more thing they're going to add on there. But finding sponsors that you can work with, that you can invest with. I'm a big passive investor myself in real estate and then other asset classes. So it's something that when I'm looking for sponsors, and number one, let's just say we're talking multifamily to make it easy, because that's what we both kind of focus on here. And when we're doing that, it's going to be, you're looking at states, you're starting from the top and you're working down. So we're looking at states we want to invest into, that takes out a bunch. Then we're going into markets within those states that we want to invest into, that takes out even more. And now you're going to find yourself with several different markets that you might be interested in. And then in that area, you're really going to find the different sponsors that are focusing on that. And you're going to find what their track record is, and then also how they're set up. And I think how they're set up there, their operations, is kind of more important than the track record for most people, because a lot of where we have been for the last, anybody that started investing in real estate in the last 10 years has seen an upward trajectory, no matter how good or bad they are. I mean, unless they're terrible, they've lost money. So, that doesn't really help much. The main thing is I really want to see people that focus on specific markets. So like when we partner on deals, we work with 3 different operators currently in markets where they specialize. And in one of them that we work with, like in Dallas, for example, our partner there on the ground has over 3,000 units. It's within like a 20-30 minute drive. So that shows you kind of how cemented they are in there, how their teams are cemented. They have their own property management. And that's what we want to. We don't want to reinvent the wheel. We want to partner with people that already have the system in place, the team in place. Because if I can look at your other 8 or 9 deals and they look fine, then I invest into them passively. Maybe a partner invests into them passively. We see how those goes. And then after we've kind of gone full cycle on that, then that's something where we might bring new deals and partner with them on future opportunities. So it's really seeing, I would avoid people working with operators that are all over the place. They've got here, maybe 2 markets you can have, but when you start going more than 2 markets, unless you have which few people have, let's say, the network to be able to have 2+ markets that they're focusing on. So that's kind of what I want to see too. You don't want someone that's just buying one property in one area. I invested passively into a deal years back, and then we did a deal with one of our operators we work with now. And when I invest into it, it was the 7th asset in this market, right? And that's just printing money. They've had 6 that are set up. I know that your property manager is not going to change. I know that you're not going to have issues finding contractors per se. You already have this all set. And so when I'm coming in, I'm just kind of just piggybacking on what you've set up. And that's the position you want to be in. And so that's kind of what you want to see, is how that's set up on the ground. Someone that's buying their first property, 1,500 miles away from where their last one is, probably doesn't have that. You know what I mean? So those are things I would look at when you're looking to passively invest, or if you're looking to go GP on a syndication with another operator.
Awesome stuff for passive investors' point of view. And one follow-up question on that. How do you find these operators? What are the ways you find these operators?
It's a lot of networking. It's going to a lot of conferences. I mean, I started going on conferences myself, looking for syndicators, I think like 2017 or something. So it's, many years I've spent finding people, following them, investing into deals, and then possibly partnering with them on future deals. And then also seeing what you like about one operator versus another. And it assists a lot because I might passively invest in something. I don't really care for their communication, but I passively invest here and I really like their communication style. And so that's something I'm going to implement into my business, because even if my partner doesn't have as much communication, we're going to be the ones that are going to be on those property management calls weekly, at least talking to our partners weekly, at least. And it's going to be something that I can now provide that same experience to our investors and the updates. I mean, I always like to have more information. And so as a passive investor, it's great to have the monthly updates when everything's running smooth. But if we're getting close to, or there's an issue, or if we're selling something, or if we're planning on selling it, that's when we kind of turn up the communications. And that's something where I want to know what's happening or what's going on versus like where we are now or March 2020, lots of emails going out March 2020. So people want to know exactly where it was. And I was looking out for a lot of investment emails from syndicators I was passively investing with too, and seeing where those deals were. And, those important parts of where you see what's happening and how they handle those situations is important for building relationship, because I want to find syndicators that you're going to not just do one deal with, spend the time, do your due diligence on them, because I look at them as someone, hey, I can invest with them for the next 10 or 15 years. So you're doing your due diligence. And that time when you're spending the time checking out references or reviewing deals or speaking to them or asking them questions, it's not a waste just for one investment. You know what I mean? It's something where I'm going to consistently invest with them, maybe 3 or 4 back-to-back deals over the next 15 years. And that's where you're really building that relationship, and they're becoming more aware and they're becoming better investors alongside you.
Awesome. Great approach. Thank you for sharing that. So let's switch towards active side. So you guys have, awesome experience in renovating and repositioning multifamily assets. So share me which markets you are focusing on, share me your core strengths, how exactly you guys are repositioning and renovating properties.
Yeah, so right now we are in 3 states. We are in Texas, mainly DFW, so Dallas, Fort Worth. We are in greater Atlanta area, Georgia. And then in Florida, we are in Tampa right now. And I would say our target there would be the whole, what we call I-4 corridor. And that means it's going from, Jacksonville through Orlando to Tampa. So that area of Central Florida. And how we would work with when we have projects and we're doing renovations, it's really, we will split up our roles when we're doing a syndication with another sponsor. And what that means is that if we're going to be on asset management calls, so if we're looking at a deal and it's in Atlanta, for example, well, we're not going to be the boots on the ground there. Okay. We have an operator we work with there for many years, and we've done multiple full cycle deals with. They're going to be the boots on the ground. So they're going to be handling a lot of dealing with contractors, and they're going to be dealing a lot with actually going to the property on a regular basis, reviewing how it's going. We're going to be on their side where it is doing a lot of calls with property managers and seeing exactly where we are on that end. Because when you're talking with property managers, that's, you get an overview. And when you're getting your weekly reports from your property manager on rentals and vacancies and everything like that, that gives you a really good view of where you are in the process. And the larger the asset, the more calls you're going to have, right? If you just have a duplex, you can get a report 45 days after them. You know what I mean? It's not going to be the end of the world, right? And you're going to have an idea about it because you're going to see some money come into your account or not. When you're with larger properties, letting something go to the end of the month or something like this, it's a huge beginner mistake, because you want to see if there's an issue, you want to tackle it and see. You want to see, why aren't we getting leads from, like, one of our properties in Atlanta, we somehow don't get any leads from apartments.com, right? But we get them from Zillow, and we get really good tenants from Zillow. So it's like, okay, well, let's double down on this approach. But I also kind of want to know, why is this tenant base? I mean, is the people that we're looking for potential tenant, is this, they don't look on apartments.com, they're Zillow people. So it's something that, knowing that, and then that's something you can now roll out to other properties. So you're like, okay, well, we had really good experience with a B-class property here. Let's try it here in our property in Tampa with a lot more. And having that call and the rapport with your property manager and reviewing those reports as they come out, that's something that you really can see the trends and get ahead of it. Because what you're doing now, it'll start, any type of issues you have are going to start mounting on each other. And then you're going to see 6 months down the road, you're going to see major problems. And it goes the other way too. You put new management into a property, you change management for the better. It might take a year for that property to really start showing it because you've got people that are in there. It's a slow thing. It's real estate. So you might see little changes incrementally, but when you look back on it, it might be night and day from month 1 to month 13. So having defined roles with who your partners are within the group, and then making sure that, you're reviewing all changes and making sure that if there is something like, we're buying businesses, so it's not going to be a straight line up, right, to the right. It's going to be something where there's going to be bumps in the road, and figuring out what those bumps are and finding out what they are. And then you can explain that to your investors because they might ask, but it's also something, it's one of those bullet points. Hey, this is why our NOI is down 0.8% this month. And you can tell them what happened and why you think it is, and when do you think this will be rectified. So a lot of communication with the people that are there on the ground is important.
Thank you. And what is the reason behind not getting leads from apartments.com? What is the reason behind getting leads from Zillow?
We're working on that right now, but if they're coming in, they're coming in. I mean, we get some foot traffic in that property, so I'm not too worried about that. And our occupancy is really high. It's like 98%, always pre-leased, like near 100. So, I mean, it's just a weird thing, you know what I mean? But figuring out what it is, and then you're like, okay, so we know it works. I would like to know for myself, right? Just personally, why this isn't working. But hey, it is what it is. Let's put more, a little bit more gas on the fire for Zillow and start advertising more there if that's what's going to get us more leads into the property and keep this occupancy and collections high. So just small stuff like that, which you'd never think of. You'd think that, all that stuff's the same, but you have different people with different, some people might be looking more for houses on certain sites. Some people might be looking for apartments more on sites. You might have people that are just kicking tires on sites. So I think it's a little bit of all this, but I think it's very market dependent too, because we haven't found that in our other properties up until now.
Thank you. So would you share any best experiences so far?
So I would think when I started out in real estate, my first project, the first 3 family, that was a little bit of work. It was over my head with that a little bit. My second project was much more finished. When I purchased it, I bought it from another real estate investor that had done a lot of work to it. So that made it much easier for me to walk in and just clean up a couple of things and get it fully rented out. My third project, which was my first commercial property at the end of 2009, and that one was a completely vacant property. And that was a lot of work. It took a lot of money to put that property together. And I was able to renovate it and get it fully rented. It was right around 100 days. So and that was during the winter of Connecticut. So it was not the easiest time to rent properties, but from that, I think it was like Christmas in 2009 all the way through to the spring, we were able to renovate it and also to get the work done on it. So that would be one of the first big wins. The other one, I would say a few years later when we did our first syndication, which we sold a couple of years ago in Tampa. And that was a lot of work. It's a lot of work. I had people that were asking me to invest in properties that I had known. And I was like, well, when I find one, I'll let you know. And the first time that you're raising money and actually dealing with investors in your circle, you don't really know what's going to happen. So I had a really good turnout with my investor base. But I had a couple of partners in that project, and, one of them in particularly could not raise what they thought. So it put us all back on how to get aggressive and start going through more because, we already had an idea of what we were each going to raise just verbally, like what we thought. And then when it didn't happen, then we had to really dig into, the other partners had to really dig in and, raise up that additional money because it's a different thing. And that teaches you a lot about dealing with people with raising money, dealing with people with investing. And then it's how important it is to get oversubscribed on your properties. You know what I mean? And build that buffer zone because people, for one reason or another, from the time that you talk to them to the time that they want to invest to the time that you close, those are 3 really separate times, and a lot can change in someone's life in that time. So that was the biggest one I've had, I would say, is getting that closed. That was quite the process.
Okay, got it. So what are the 3 lessons or 3 important things you learned from raising capital?
If it's your first time raising capital, 50% of your investors will not invest. So if you need $1 million, make sure you have soft commitments for $2 million. And that's for your whole investor base. Make sure everybody else has that you're working with. It's going to be a lot harder than you thought on that end. I would say the other thing too is having a track record is, I wouldn't raise any money or I wouldn't become a general partner until I've done a deal myself. It can be a duplex, it can be a triplex, whatever it was. I mean, I did some small properties before, and that gave a track record for many years of doing it. I also like the partner if it was on a new deal that they were syndicating, their first syndication deal. I'd also like to see that they have some self-management, property management experience themselves. I want to see if they've actually managed the property themselves, because hiring a property manager is much different than managing a property yourself. I mean, the intricacies of managing people, collecting rent door to door, collecting people rent, knocking on doors for people that haven't paid rent, dealing with contractors on the ground, negotiating with contractors in your basement to get stuff done. I mean, all the stuff that goes on when you need to get something done where with a property manager, that's kind of all masked a little bit. You have someone else that's doing that third party for you. You might not know how that goes. So having the experience is, I would say, number two. And that could be, if you don't have real estate experience, have business experience. Personally, I would always suggest, and I would never invest with anybody that hadn't done any type of real estate deal before themselves. You know what I mean? And understood exactly. You don't want them to learn on your dime, right? So those would be the main two ones. And if I was saying for anybody else raising money, it makes it easier when you're buying better properties in better areas. Because number one, always buy better properties in better areas. Focus on C+ and above areas. And when you have, invite your investors out to the property, you know what I mean? With that first deal, as you would always be in a better area, I would also do maybe a lighter value add deal, right? I mean, we're all talking about value add to make money. I understand that. But when you get into huge renovations on your first project, it can be very daunting. There's always more that has to be fixed. It has to be done. It's never as easy as the broker's performer says or what you think. There's always going to be an extra roof that has to be done. There's always, you thought the plywood was fine under these roofs and it's not. I mean, that's just stuff that just pops up. And I think now having and squaring away more reserve funds, even though we've never had an issue with depleting those, that always just gives investors a lot of it makes it easier to raise money when you have reserve funds. And when they see that, what's your break even occupancy? Oh, it's in the 60s, and then you tell people, hey, here's the financials, and it hasn't gone below 88 in these years. That's going to make people that want to come on board with you. And, lenders require all these different things when they're going to invest the debt into your property. They want to make sure that someone has experience. They want to make sure there's a property manager. Sometimes it's not self-managed. I mean, there's a reason for all this. I mean, they've been doing this for many decades. And I think if you are on the same page as the lender with this and requiring that as a passive investor or as a GP, making sure it'll just make your package look better for your investors. And then the last point I would say is just raise money and start building the relationships a lot earlier than you need the capital. Okay. It's just that, it's very difficult on that first deal. I had to speed up some relationships to try to get capital to make up for my other partners. And it wasn't what I would consider the most professional thing I've ever done. But now it's much different. You know what I mean? It's much, if I speak to someone today and they're interested in investing, I know that it's maybe next year. You know what I mean? It might be 12, it might be 16 months, you know what I mean, before they actually invest. And that takes the pressure off everything. It takes the pressure off the conversations, takes the pressure off the emails and the contact follow-up. You might get an extra email from us when a deal goes out, but there's not going to be someone's not going to be calling you, asking you for money. And it also takes down your credibility too. So make sure that you start building this funnel a while in advance to what you start raising money for.
Yeah, awesome. And would you also share any challenging experience?
Challenging experiences, I would say in the syndication realm, I would say that COVID was challenging and not so much, a lot less than I thought. And then I think a lot of other real estate investors, multifamily investors thought because of the amount of government money. But the challenges that we really saw was coming up really in 2022 when a lot of government money was cut from these programs. And not with our B-class properties, but we had one C-class property still at that time, and we're selling it right now. That was challenging because you had that's the tenant base that you're working with in C-class, and that was challenging to work through. And now we see with the interest rates increases over the last year and a half, and that's challenging too, but it hasn't really affected us too much. We have just one floating rate debt property, and it's exceeding expectations. Even if we didn't have the interest rate cap on it, we'd still be fine. So it's not too many other operator sponsors can say that. And, we'll see exactly how that pans out at the end of this year and into 2024. But, that could be the writing on the wall for a lot of people.
Cool. So any personal habits that are helping you to be successful?
I would say I have kind of a morning ritual of, reading, getting a lot of stuff done prior to starting work, reading. And then I also like to do and that's just not, it's books, but it's also, I have different websites that I like reviewing every week. We put out a newsletter at our company on Wednesdays. So usually Monday evenings is really my review time where I'm really scrolling through and seeing exactly where the market is, seeing exactly what forecasts are, reading charts so I can educate myself and my team, but also to send it out to our investor base and people on our newsletter. And that's something that just knowing exactly where everything's going, good or bad, and see what people are thinking and knowing that it's just people's opinions and kind of, because you have a lot of investors that might see something and they, oh my God, and they send it over to you. And if it's just one guy, man, at CNBC, I don't know. I mean, I look over here and I'll show you all of our financials, but we don't see it here. And I see a lot of that with people where, when you're reading stuff, they're talking about, they have a headline that looks terrible, and then they find out it's a market that's 2,000 miles from where you invest or something like this. And it's just, you have to make sure that you understand everything and, let people know, because that's going to come back. Investors will be asking you that.
Awesome. Any books that impacted your life?
The main one I always say is 80-20 principle. And I think that's no matter what you do in your life, it's from sales to real estate investing to anything else, it's hugely impactful. So read that. It's 80-20 principle, and just really 80% of what you spend your time on only gives you 20% of your results. And trying to find out, which is usually blatantly right in your face, where the 20% is that makes 80% of your results is usually kind of scary. That's so, that it, but you just kind of haven't brought it out in front, and then really focusing on that and then really cutting off anything else that's not giving you the 80% benefits.
Awesome.
I would also say one other one, obviously everybody knows Rich Dad Poor Dad, all that kind of stuff. But yeah, no, 80-20 principle is a big one. And there's another one also on marketing, 80-20 principle on marketing, which is very important for anybody in sales or for any type of business that requires marketing, which is everyone.
Awesome. And how can listeners can connect with you, Charles?
Yeah, so we have, our company is Harborside Partners, harborsidepartners.com, and you can go there. We have, as I mentioned before, we have a newsletter, so feel free to sign up for our newsletter. We have a free guide to passive investing in real estate, so feel free to sign up for that. And then if you're interested in investing, there's also a link there. But yeah, sign up, see exactly what we've got going on. And if you're interested in investing, set up a call with one of our partners, and we look forward to talking with you.
Awesome. Thank you very much, Charles. I really enjoyed the conversation.
Thank you so much for having me on.
Thank you.